welcome. My name is Neal Bawa. I am a demographer, a data scientist. I'm somebody that really enjoys looking at large amounts of data and churning through it and trying to figure out what makes sense and what doesn't make sense. If you don't know us, Multifamily University is basically a website that aggregates data-driven content, and we do all kinds of content. A couple of weeks ago, we did a climate change webinar, the impact of climate change on real estate, and there were hundreds of people that attended that. Last week, we brought in one of the top data experts in the United States for real estate. His name is John Burns, and 525 of you attended as he talked about interesting trends that are coming up, and it was fascinating to watch that. We have upcoming events. We have the 10 disruptive trends that are going to change real estate in the next 10 years. That's coming up next. That's my next live presentation. Today's presentation is my favorite because it's been running the longest. And it's evolved over time. Even if you watched this before, you're going to notice it's changed, it's evolved. And it is a methodology which at its very core is, how do I find the best cities in America to invest in? And there's two ways of doing that. One is you can watch the January presentation that is on our website. It's archived. It's called Real Estate Trends. Go to the toolkit, go in there, watch it. That's one way. It's the spoon feeding methodology. But many of you are not really satisfied by, well, how does Neal pick Indianapolis as his dark horse? How does he come up with Phoenix as the most attractive city in America to invest in? Well, we're using a massive amount of data, but a lot of it really comes down to 5 or 6 fundamental things, right? So we churn through hundreds and hundreds of different metrics, but what about the main ones? What about the core ones? What about, could he teach those metrics to me so I could, all of a sudden somebody mentions Destin, Florida. I've never even heard of Destin, Florida, but this person swears Destin is an incredible investment opportunity, which by the way it is. But I've never heard of Destin. So how do I know if Destin is better than a city that's 10 miles away from me? How do I benchmark Destin against every other city that I know about? And so a long time ago, I decided that I needed to give people a way of doing that in a way that was independent of me. They wouldn't need to come back to me and get some information. I basically wanted to build a toolkit that was independent of Neal Bawa, independent of Multifamily U. So I built it based on other public websites that have been up for a long time. And I created a simple benchmark system where you can benchmark a city, any city in the United States, big or small. And the system is called Location Magic, and it's evolved over time, and I've changed it. But the goal was this. In 10 minutes, you could pick up a random city that you never heard of, like Destin, Florida. And you could say, well, I'm going to pick up another random cities like Idaho Falls, Idaho. And I'm going to take these two cities and I'm going to measure them and see if Idaho Falls is better than Destin or if Destin's better than Idaho Falls. And that's what I'm going to teach today. I'm going to teach location magic. But throughout this presentation, I'm going to talk about the cities that you guys have plugged into the chat. So there's going to be lots of conversation. Whenever I have a chance, I'll pick up one of those cities. So let's get started with this presentation. I am going to go ahead and share my screen here. And boom, location magic. All right, whoops, I think I need to swap displays. There we go. So before I get started, just a little bit about me. Most of you know me, so I'll keep this super short. We have a $507 million portfolio of 22 properties. It's in 10 states, about 3,300 units. A lot of it is multifamily and townhomes, but there's also student housing, there's self-storage, there's industrial. There are 500 active investors that are invested with us and 5,000 investors that attend these kinds of events that we put up. And all of that is fun for me. It makes me money. It makes my partners money. But it's not as fun as what I'm doing right now, because at my core, I'm a presenter and a demographer. And that's why this sort of stuff is very interesting to me. And you look at these properties and you look at our returns and you go, how did this happen? How did you end up in so many of these superstar markets? And the answer is, I did every day for the last 5 years what I'm about to show you. It's as simple as that. It really is. So here's the most boring slide, by the way, in our presentation. We're required to read this to you. We're not investment advisors. This seminar is for educational purposes. All investments involve risk. Be aware of your risk tolerance. You're free to accept or reject investment recommendations. I'm going to make a lot of recommendations today. You have to make sure that you understand you're free to accept or reject those. A recommendation is not a guarantee of anything, right? Do not invest your money on our recommendations alone. Consult a professional advisor, do lots and lots of due diligence. Yes, this is being recorded. Yes, a copy of it will be in your mailbox tomorrow. And yes, you'll get not just the deck that I'm about to show you, but also the companion Excel spreadsheet that allows you to crunch numbers on your favorite city. All right, let's talk about how do we find these cities? How do we benchmark these cities? The first, I call them real focuses. There's 5 things I'm going to teach you today. The first one's called population growth. So it's real focus number 1. You want to make sure that the city that you're investing in, if it's between 250,000 people and 1 million in population, which is most investable cities in the United States fall somewhere in that 250K and 1 million in population, then you want a certain amount of population growth in this city, 10.5% population growth between 2011 and 2019, right? And you might say those years seem fairly random. The answer is no. That's where the publicly available data is available for that you can get access to in 60 seconds. So I chose those numbers, 10.5% for cities that are between 250,000 and 1 million in population. But that number is going to go down if you're investing into a very large city like Phoenix. It's going to go up if you're investing in a micro city like Idaho Falls, Idaho. If you're investing in a micro city like Destin, St. George, Utah. If you're, St. George is the absolute investment darling of the United States if you care to invest in small cities. If you're investing there, then growth has to be higher. Why? Because you're taking a bigger risk. It's much easier for something to go wrong with St. George, Utah, than to go wrong with Los Angeles. So when you take a bigger risk, shouldn't you get a bigger reward? Absolutely, you should get a bigger reward. So even that 16% number, I encourage you to push it up rather than say, no, I'm going to go into a small market, but I'm going into a market that only has 10.5% growth. Don't do that. You're selling yourself short because you're taking a lot of risk and not getting a lot of return. Now, what happens next year? I'm giving you this system, this toolkit. You're not supposed to come back to me next year. You're welcome to. I do this presentation every year, and every year the numbers change. But if you want to have a rule of thumb without coming back for an exact number next year, right? I'm going to give that to you. In 2020, add 1.2% to this 10.5% number. I want you to make that number so it'll become 11.7, and it'll be between 2011 and 2020. So this year you're measuring a 9-year time frame, 2011 to 2019. Next year you're going to be measuring a 10-year time frame, 2011 to 2020. Now, I'll probably give you a more exact number than this if you come back next year, right? And this system evolves. So you're welcome to come back to Multifamily University, download a new version of the Excel spreadsheet and a new version of the deck next year. Usually we update these in February each year because that's when all of the publicly available data changes, right? So that's population growth. And you might say, okay, this is all useful, but where the heck am I going to find this information? Well, let's do a quick demo on Real Focus 1. Population growth is the easiest of all of the demos. So I'm going to demo that one first. Hang on. There we go. Whoops. Boom. So I'm going to do a population search. This word search shouldn't be in here. So you just type in population followed by the name of your city. I use Columbus, Ohio for my examples. It's actually a pretty good city to invest in, but not my favorite. Okay, not my favorite because I didn't want to pick one of my favorite cities because that would be biased. So I picked a city that I consider to be a good city for investment, and that's Columbus, Ohio. You can pick whatever city you want. For example, you could pick Destin, Florida, which I'm saying is an interesting little tiny market in Florida. Not, again, my favorite market. That one clearly is Idaho Falls, but a nice market to invest in. So you just basically plug in whatever city you're interested in investigating, you hit enter, and Google gives you this wonderful graph. And this graph is actually very powerful for free data on the web, because not only is Google showing you what's happening in Columbus in terms of population growth, look at where my mouse is, right? It's also telling you what's happening to other cities like Columbus. So, somebody asked me questions about Dayton, Ohio. Somebody asked me questions about another city in Ohio. There were a couple cities that they asked questions about, Youngstown. Well, I'll tell you, in general, I don't like Ohio, and there's a very simple reason for that. It seems that all the growth in Ohio is concentrated in one city. And as you can see, that city is in blue. That blue line is Columbus. You notice it has other great cities. There's Cleveland, There's no population growth, there's a slight population decline. There's Cincinnati, there's no population growth, there's a slight decline. Now, does that mean that no one should invest in Cincinnati or Cleveland and people won't make money? No, of course, that's ridiculous. It's a nonsensical idea. What it means is that you may win a little bit more on the cash flow side when you go to Cleveland or Cincinnati. But there is no doubt in my mind that you will lose a lot on the back end appreciation. Because for back end appreciation to happen, it really has to happen in a city with significant population growth, with people fighting over land, fighting over properties. That's how you get significant appreciation. That's how you get tailwind. We all have traveled in planes where there was a headwind, so the plane was delayed by an hour or two. But then we've also traveled in planes where there was a tailwind of 100 miles an hour, maybe the Gulf Stream, and we got there an hour early. That's what's happening when you invest in a city that has a certain amount of population growth. Not a little bit, but a certain amount. What's that number? I just gave it to you, 10.5% over the last 9 years. And you might say, okay, so how do I calculate that? Well, very simple. Every single person listening to me right now is going to get this Excel spreadsheet. You see this spreadsheet? You're going to get it. This Excel spreadsheet allows you to plug in two numbers, one here, and then the spreadsheet tells you what the population growth over that time frame is in that 9-year time frame. Notice population in 2011, 2019. Okay, so where do I get this data, Neal? It's on the page in front of you. This is a 2019 number. 878,553 people lived in Columbus in 2019. How many people lived there in 2011? Just move the cursor back. Right there, 779,573. Take both of these numbers, plug it into the Excel spreadsheet that I'm going to give you, and it's going to tell you if Columbus is growing faster than 10.5%, which is the number I gave you, right? Yes, it is. It's growing at 13%. So its population is growing so fast that people are fighting over real estate. And you want to be an investor in a place where people are fighting over real estate all the time. And they're doing that in Columbus, Ohio. Are they doing that in Cincinnati? No. Are they doing that in Cleveland? No. But often I find that home prices in Cleveland and Cincinnati are similar. Now there's rent growth that's happening in Cleveland and Cincinnati because they're building a lot less than Columbus. Columbus is building a lot of new stuff. Cleveland, Cincinnati, not so much. So there's still rent growth happening there. So people are thinking these are equivalent. No, they're only equivalent on one part, on the rent growth, on the cash flow. They are not even close to each other on the long-term 5-year, 10-year appreciation. Columbus is an absolute stud when it comes to every other city in Ohio, including Youngstown, including Dayton. Dayton's actually lost the most population. And if you plug Dayton in here, you're going to see some horrible numbers. Horrible numbers. All right, that's population growth. Let's go back to our graph. We're going to go back. There we go. And we're going to move on from population growth to real focus number 2, which is median household income. So you want to have a certain amount of household income growth, not household income, but growth. And so on the screen, you see that number, 35.2% in income growth between the year 2000 and the year 2019. So over that 19-year time frame, you want a 35% income growth because that supports the rents that you are trying to get, right? You need that income growth to continue to be able to raise rents, right? And that number applies for a city of any size. Doesn't really matter if it's a small city or large city because inflation sort of affects all parts of the US almost equally, right? And I know, by the way, there's 200 of you watching. If you have questions, it's better to plug them into the Q&A box because it's easier for me to answer them. If you plug them into chat, I'll try to get to them. But if you have questions, keep typing them in. As I pick more cities from your list, I'm going to try and check them off in the Q&A boxes. All right? Okay. All right. So where do we get this information? Where do we get the median household income information? And before I go there, most of you are like, okay, so what do I do next year? I'm sure this number is going to change next year, Neal. Yes, it changes. So this number applies to this year, 2021. Next year, I want you to add 1.5% growth to this number. I want there to be 1.5% income. In fact, because 2021 is a bizarre year, because of COVID, I'd like you to add a little bit more. If you could add 2% to that number next year, that would be great because we're coming out of the recession and incomes appear to be rising very fast. So 1.5 though is reasonable. If you want the true number, come back here next Feb and you you might be surprised that I go from 35 all the way to 39. Can't predict the future. So you're welcome to come back in a year. If you want to be lazy, just add 1.5%. Okay, fine. Got it, Neal. Where do I get this number for any particular city? Well, you see this website here, city-data.com. Don't forget the dash. City-data.com gives you this data. Let's go back and take a look at city-data.com. Hang on. There we go. So city-data.com, what I've done is I've already plugged Columbus in. So when you go to city-data.com, it has a form fill. You plug in Columbus, Ohio. You get to this page. You get past all the ugly ads because, hey, free data. They got to make money somehow. You scroll down, keep going, keep going, keep going. And right there, you see estimated median household income in 2019. Boom, 57,000. And then it gives you another number, 37,897. So this is the old number in 2000. This is the new number. You've gotten two numbers and you have an Excel spreadsheet that Neal Bawa is giving you. You plug in the 37 number, you plug in the 51, and you notice that income in Columbus has grown by 36%. Barely enough. Boy, Columbus just made it by the skin of its teeth because the number that I gave you was 35 point something, and they basically did 36%. So you might say, here's a question people ask me. So what if Columbus was 34? I wouldn't invest in Columbus because you said 35.5 and it was 34. The answer is no. What you don't want is you don't want it to be below all of these 5 metrics. But if it's a little bit below on 1 or a little bit below on 2, it's okay if you like the city and you see opportunity there. It's a lot below on 3 of them. Well, then why are you using the system? It's worthless. Throw it away and do something else because you're not listening to the system. A lot on 3 metrics, that's not a good city to invest in. A little on 2 of the metrics, little under, I think that's okay. I think that's all right. All right. So now we basically looked at income growth and we've come up with 36% for a city like Columbus. Let's look at the next one. Let's go here. We're going to go back here and we're going to look at the third real focus, which is median house or condo value. Now, as you can imagine, this number needs to be revised. The last 12 months have been the most insane home price growth across the board in the United States that we have seen pretty much ever. We've seen 2013 was a very strong year. So that's one year that sort of compares with the kind of craziness that we're seeing. But 2013 was not in the middle of a pandemic. So I think the numbers that we're seeing are amazing. So even though I put this number in January of this year, what I would advise is that you do not come back, do not apply this 2.5% growth number for next year. Come back to me next year and I'll give you a number. For now, I'm raising this number. I'm saying this number needs to be around 50 to 51%. 51 is probably the best number because of what's happening month over month, right? So we just heard Austin home prices are up 42% year over year. I think it's a great rental market. It's got no cash flow. You okay with no cash flow? Best market in America, Austin, Texas, 42% median home price growth. You okay with low cash flow? Boise, Idaho, 23% year over year growth. You okay with low cash flow? Phoenix, Arizona. These are markets that are growing extremely fast but have low cash flow because you're really paying up today. Some of the markets that have a high cash flow or reasonably high cash flow that should appreciate are Jacksonville, Florida. Somebody asked about Jacksonville. You know what's nice about Jacksonville? On average, you make 1.5% more of profit than you do in a place like, let's say, Boise. You make about 3% more on your money compared to Austin, which is pretty low down there. And then, of course, there's places that are lower, like the San Francisco Bay Area, Boston, New York. They are very, very, very low cash flow or almost no cash flow or negative cash flow. But places like Jacksonville are actually fairly reasonable. And so are Charlotte and Raleigh. Charlotte, Raleigh, Jacksonville are metros that grow quite fast, that historically maybe have not done as well, but are set up to grow fast. But your overall rental yield there is a lot better than any city in Texas, right? So Charlotte, Jacksonville, and Raleigh will beat the crap out of Dallas, Houston, Fort Worth, San Antonio, and especially Austin when it comes to cash flow, but they still give you significant appreciation, right? So let's go back to the numbers here, right? So I'm not asking you to look at 47.5, which is on the screen. I want you to look at 51%. And you might say, okay, where do I get the data? Well, remember, we were on this page and we were looking right here. We were right here, correct? Well, look down 2 inches right there. You've got two numbers, 99,000 in 2000, 173,000 in 2019. You've got two different numbers. You take these two numbers, you plug them into the Excel spreadsheet, 99, 154. Actually, never mind. Is it 154? It's 173, 300. 173, 300. Oops, that's a bug. All right, so now you're seeing that Columbus home prices have grown really well. They're up 75% in that time frame, 2000 to 2019. That's a pretty good number, just so you know, because obviously there was a crash in the middle. So that market is doing phenomenally well in terms of home value growth. And you might say, is that number, indicative of a boom? No, there's markets in the US that have doubled in that time frame. There's markets in the US that have done 220%. Austin is a perfect example of a market that's increased by that amount. Boise, Idaho is another market that's increased tremendously. So that's not a number indicative of a bubble. I just think it's a good number for you to know. All right. Real focus number 4, let's go back to it, is crime. Let's go here. And real focus number 4 is crime. Now, I spent a lot of time looking at crime and wasting my time when I was designing the system, but it was really change in crime, delta of crime, that really made sense. So there's here it says below 500, but I also want you to invest in cities where crime is smoothly going down. Smoothly going down. I'm going to show you examples for Columbus, of course, but you can apply that to just about any city in America. So I want you to go to a city where crime is below 500 in the crime table on citydata.com. I'm about to show you where that crime table is. Now, when you go to a smaller city like Idaho Falls, I want you to use 400 as a number. Recently, I've been encouraging people to go to smaller cities. I have always loved smaller cities, but in the past, I was very hesitant to send you to smaller cities, given that there was a stigma to going to smaller cities. Of course, post-COVID, small cities are the darlings of the world. So I feel much more confident about talking about Idaho Falls and Logan, Utah, and these kinds of small cities, which are really the places where you make the most amount of money. So go to a small city, look at 400. Go to a medium-sized big city, look at 500. You want crime to be below 500. All right. So now, hang on. Let's go and look at that data. So for Columbus, I was here, right? So we were looking at data right here. So I want you to scroll down a little bit. Scroll down, scroll, keep scrolling, and you get to this blue table that says crime rates in Columbus by year. And you see the murders, the rapes, the robberies, assault, burglaries, thefts, and so on and so forth. I want you to ignore all the stuff that's in gray. I just want to look at this stuff here. I just want you to look at the crime index, the blue line. And you notice that on the left, the data is from 2006. And on the right, the data is current. It's 2019. Now, a lot of people might say, but we're in 2021. Why is it that all of your data is 2 years old? Number one, that data is public and it's free. If you want to buy data, you want 2021 data, I want you to go to localmarketmonitor.com, localmarketmonitor.com. Write that down. It's not in my notes. And you notice that they are the Crystal Ball Award recipients for accuracy of forecasting in real estate, right? They win this award more often than anybody else, right? I love their product. I pay for it. It's great. And it's current. It's got 2021 data. My feedback to you is, if you use their data and you use the city data, you end up with the same list of cities, because cities don't change over years, they change over decades. You're welcome to spend a few $1,000s here. There's a very high chance that you'll end up with the same list of cities. I leave it to you. You've got both options. All right, so going back to crime. So we look at crime, and you'll notice that I wasn't just talking about crime levels. I wanted you, let me see, where did I go? Did I lose? Yeah, there we go. I didn't just want you to be below 500. This is a number that needs to be below 500. The 2019 number, the crime index in Columbus is 362. I want this number to be below 500 in a city that you're investing in. But I also want to see a very aggressive, smooth reduction in crime. 667, 621, 587. Yes, it goes up for a year, but then I want it not to go up for 2 years in a row. I want it to come down. 561, 423, 406. 414, 419. Here it increased just a little bit for 2 years. And then you notice a sharp decline, 375, 362. That's ideal because crime is inversely proportional to investor profit. Wherever the crime goes down, your profits go up as a real estate investor. So it's very, very powerful for you guys to look at the crime data. Now, before I give you the fifth and the most powerful indicator, as you probably figured it out by now, it's jobs. And obviously this year is a weird one for jobs as well. So I'm going to give you that fifth indicator, but I want to tell you a little bit more about what I do. So one of the things that I do that I love doing, you can tell already, I love doing this. This is so much fun for me compared with my day job, kind of managing properties and building properties. I help people become financially free with real estate. I teach them how to invest in apartment buildings. And you know this already. I mean, apartment buildings are one of the best classes for long-term wealth accumulation because of all the tax benefits that apartment investing has. And I teach the last honest apartment bootcamp in America for people that want to use other people's money. I've received $146 million of other people's money to buy and build my dream properties. I want to teach you how to do that. No one in the US that I know of is better suited at doing this than us, because how many people that you know that have taken 146 million of other people's money? Training is very specific. I don't believe in fluff. You notice that I got right to the point when I was teaching this. I teach 50 plus tangible tools like location magic, which you're getting today. You can see that in the reviews. Very specific. You can put them into practice right away. The goal is to get you out there buying apartments as quickly as you can. So the training is very specific. Secondly, there is no pitch. In fact, this is the pitch for it. There's no second level. There's no subscription. There's no upsell. There's no coaching, mentoring, tapes. There's nothing. When you come in, you're going to spend 100% of your time learning how to buy apartments. And you can see that from the reviews that everyone agrees to that. As far as we know, this is the only bootcamp in America that makes this promise. Number three, it's filled with technological shortcuts, and 50 demos. 50 demos of how I run my business. I run one of the fastest growing syndication businesses in America. And there are 15 or 16 demos in how to raise money, where you actually are looking at our database and how we raise money. In the last month and a half, we've raised $22 million. Last month and a half. And the technology that we use to raise that money is completely naked and visible, completely naked, completely visible in the bootcamp. As far as we know, no one else attempts that. So very step-by-step, filled with shortcuts, filled with actual demos, actionable demos. So it's got incredible amount of content, right? So I can't go through all of it. Finding brokers, properties, how to evaluate properties, finding property managers, interviewing property managers, working with property managers, and most importantly, how to raise money for your project. So all of that is in one bootcamp. The bootcamp is coming up in a few weeks. It's about a 10th of the typical multifamily bootcamp in America. Yes, you heard that right, about a 10th. And it is in early bird. So you're welcome to approach us and we'll give you a coupon that you can use to sign up. And you can sign up at multifamilyu.com/bootcamp. Now, for those of you that are interested in investing in our projects, we have projects in various places. We've got one in Phoenix called Avondale that's almost sold out. We've got another one that shares might be available for, and it's in a different location. So if you're interested, please approach us. The best way to approach us if you're interested in this is to answer the poll. In about 10 minutes, I'm going to throw up a poll on the screen while I answer questions about your favorite cities. Answer the poll and my staff will reach out to you and give you more information about our investment offerings. All right. The fifth and most important real focus is job growth. Some of you are geeks, total geeks like me, right? You're like, do we give equal weightage to these? And for those that, I wanted to keep the system simple, so I don't have weightages in my Excel spreadsheet. But if you had to give a weightage, I would say 40% goes to job growth, and then 60% goes to the other four. So they're 15, 15, 15, and 15%. This one's 40%. Job growth matters a lot. And I spent a lot of time trying to look at 5-year, 10-year, 15-year job growth patterns. None of them seem to correlate to your profits, to investor profits. You know what correlates? 12-month job growth. Job growth is just what's happening today. Jobs make people feel better. All of a sudden, you've got a good job. You feel like a king. You feel like, the world has really opened up to you, and you can't wait to buy that new car, that new home. You can't wait to upgrade to 3 bedrooms from 2 bedroom. You can't wait to do any of those. People behave irrationally when there's high job growth in a market. That's why I believe this is the factor. And of course, today with the pandemic, it becomes even more important. So I want you to invest in markets where job growth is at least 2%. That is not as easy as you think it might be. Lots of markets will not qualify. Now, if a market is very large, like Atlanta, then or Phoenix or Los Angeles, then you can look at 1.5%. But I would strongly advise you, do not invest in a market that's under 1.5% job growth. This is one of those cardinal rules that you do not break. Never go under 1.5%, and as much as possible, stay above 2%. Now, you might say, but Neal, no city in America had 2% job growth in the middle of a pandemic. The answer is yes and no, right? So first, let's talk about where do you get the data? Well, on the screen is the link. And you might say, Neal, do I have to write all this stuff down? No, because I'm going to give you the deck, and then I'm going to give you the Excel spreadsheet, which, by the way, has a cheat sheet for all of these. So the links are all in the Excel spreadsheet, so you'll get access to it. So no, don't have to write it down. So there's this website called Department of Numbers, and the government basically reports on job numbers in the United States at this location. So we're going to go take a look at that page, and here it is, right? So this is, oops, not this one. This one is Department of Numbers. This is the sexiest web page on the internet. It's also the ugliest web page on the internet. But the beauty of this is if you understand this page, it can make you a millionaire. It's been the source of my wealth, right? So I look at this, and obviously when I sort this column is the one that everybody cares about. And you might go, wow, have we had a bad year? Minus 16, minus 16, minus 15, 13, 12, boom, boom, boom. As soon as you sort it, the worst cities to America to invest in come up. Honolulu, not because of Honolulu's fault, obviously they're a tourism place. Lake Charles, though, was suffering before the pandemic. Midland and Odessa are the 2 shale oil communities in the US. They are the 2 most dangerous cities in America to invest in. Midland and Odessa, most dangerous cities to invest in. Las Vegas got hit because it was a tourism market. Santa Cruz, tourism market. Atlantic City, tourism market. So you see a lot of tourism markets that got hit here. Orlando is in that list as well. Santa Rosa, Napa, a lot of tourism related markets had negative job growth. But then, Los Angeles, 10% negative job growth. But if I click on this link again, not the first time. So this is kind of the do not invest list. If I click on it again, you'll notice that places gained jobs during the recession, during the last year. Ocean City is a weird one. There's reasons and not good reasons for why that gained jobs. So I'm going to skip it. But some of my superstar cities are in this list that if you've been listening to me for years, you know that I talk about these cities. St. George, my absolute favorite for the last 5 years. It's now been overtaken by Idaho Falls, but that's a close race. Provo, Utah, Coeur d'Alene, Idaho. Idaho is the fastest growing state in the union, so you'll see a lot of Idaho on this list. You'll see Boise City as well. Lakeland, Florida. I talk about a corridor of opportunity. Google corridor of opportunity followed by my name, and you'll see a corridor in Florida that I talk about. And you'll notice that the city in the center of that corridor is a city that nobody knows about called Lakeland, Florida, right? So not very impressive to gain 1.5% job growth in a year, but in the middle of a pandemic, yes, highly, highly impressive, right? So, but the problem is that even most of these are not at 1.5 or 2%. So you're like, Neal, I can only invest in like 4 places in the US, just these 4 in the at the top, how do I apply the 2% rule? The answer is because of the unusual nature of the pandemic, until the end of this year, this website is not useful to you. This website is not useful to you. Until the end of this year, you're going to go to a cached, stored version of this website from Feb of last year. Because that information, we are seeing all of those places that were doing really, really well back before the pandemic rebound at very high speeds. The only exception is some of the tourism related markets are taking more time, like Honolulu, but others are rebounding back to where they were. So you go, so how the heck do I find a copy of this website from Feb last year? The answer is there's an awesome engine on the web. It's called the Wayback Machine. Write this down, the Wayback Machine. It makes copies of the internet. It makes copies of the internet at different times. So I'm going to go here. You notice I have plugged this in here already. Department of Numbers /employment /metros. I'm going to click Browse History. This is going to think for a little while, and it's going to come up with previous snapshots of this website. So if I go back here, oops, there we go. This is 2021. I'm going to go to 2020. Let's see. 2020. There we go. So I'm going to go to 2020, and then I'm going to go to this snapshot that was taken on April 21st of last year. And you're like, Neal, the pandemic started in April. Don't pick that one. No, this snapshot was taken on April 21, but the data is February. So it's pre-COVID data. When I click on this, it now shows me the best cities in America to invest in from a job perspective. Absolutely stellar. Yuba City was benefiting from the fires that happened last year in California because a lot of construction workers live there. Cleveland, Tennessee, I've never seen it in there before, so I'm not going to comment on it. But if you live in Washington State, look at Kennewick. Kennewick's better than Seattle, better than Olympia, better than Tacoma, better than Spokane. Kennewick and the Tri-Cities area, rock star, shows again and again. St. George, always at the top of this list, superstar city. Let me tell you a little bit about what these numbers mean in the last column. 2% job growth is good. You're making sure you're not making a mistake with 2% job growth. 3% job growth is amazing when there's just so many people fighting over it. You get like huge rent increases, everything's going well. 4% job growth, which happens very rarely in the United States, is you getting champagne bottles. 5% job growth, you dancing naked on the street with your champagne bottle. You will make an absolutely filthy amount of money at 4 or 5%. And you will certainly make more than 90% of the investors in the US at 3% job growth. That's what that means. 3%, awesome, awesome. 4%, unbelievably awesome. 5%, lottery. And very rarely do places touch 5%. 5% is very unusual in the US. So the superstars that stay at 4%, St. George stays there. Boise tends to fluctuate between 3.5% and 4%. I'm going to skip State College, not very common. Sometimes, places will show up in this list because Amazon opened a place there or Walmart opened a place there. But that doesn't mean that there's really something right with that city. Cities really have to be in this list for a while. So take my list. Boise, very strong. Provo, superstar, always in the list. Provo is like, Provo is where Austin is. Provo is going to be in 20 years where Austin is today. Just understand that for those of you that understand that. And the next one happens to be Austin, Texas. Absolute superstar, incredible city. For years I've been telling people Austin is the cheapest Californian city in Texas. Austin is the cheapest Californian city in Texas. And the last few months, you're seeing everything just explode in Austin. So take a look here. I'm going to put this in. Austin, home price, 43%. Let's see. Here, maybe 42%, 43%, something like that. I have to find the right article for you. But from last year, Austin did a 43% home price increase. And there's different articles talking about different numbers. But those numbers are the highest in history. So Austin makes perfect sense and still has a long way to go because it's a Californian city in Texas. And also in Unfortunately or fortunately, depending upon your politics, it's also a very liberal city. Um, Jacksonville, Florida. I've told you about Jacksonville before. This is the bastard child of Florida. Everyone talks Miami and Tampa and Orlando and Fort Lauderdale. Everyone forgets Jacksonville. Great rent yield and very strong prospects. Look at Jacksonville if you haven't looked at it already. Phoenix is an absolute superstar. I picked it as my number one market in the US, and that was in Jan. And in Feb, March, April, and so far in May, Phoenix has crushed every other market in the United States when it comes to rent growth. Absolutely decimated everything else. 12% year over year rent growth, 20% year over year home prices. Phoenix is an incredible market. Dallas, always very strong. Salt Lake City, always very strong. Very, very strong market. Problem with Salt Lake City, no cash flow. So if you can deal with that, very strong market. Nashville, Tennessee, very strong market, but a lot of construction. So you got to be careful that you're not in that high construction corridor in Nashville. Otherwise, it's terrific. Madera, California, one of my favorite markets for the last 10 years, a market nobody knows about. I have 10 single family homes in Madera. Why? High job growth. Seattle, very strong market, very expensive. I don't recommend you look at it. Fort Collins, though, is better than Denver in my mind. It's better than Colorado Springs. It's still close enough. It's about an hour from Denver. That market, I think, is a pretty strong market. And look at the job growth. If it's a 3% job growth, it's going to see some home price appreciation. To take a look at that one. College Station is interesting market. Maybe I'm going to skip that one. Tampa, very strong market. So I think Tampa has a lot to offer, but I think that the areas around Tampa are even better. So I want you to study the area around Tampa. The city itself is a little saturated. Olympia, strong, but I think Kennewick is stronger. I think Spokane is stronger. Coeur d'Alene shows up in this list. Another one of these Idaho places that's doing well. North Carolina. Notice that I didn't say Raleigh. I said North Carolina. North Carolina is one of those unique states. The other one is Idaho. So we have two states in the union where everything is going right. So you can currently invest in any part of North Carolina, Raleigh, Durham, Charlotte, Asheville, Winston-Salem. Go anywhere and you're going to find incredible deals because you have this, you still have rents and yields that are higher than they are in, let's say, Texas, which has they're much lower rental yields now and it has much higher taxes. But here you have a lower taxation environment from a property tax perspective, and you've still got a lot of way to go for appreciation. I think Texas doesn't have as long to go as North Carolina does. So if you're on that side of the pond, look at North Carolina. If you're on my side of the pond, look at Idaho as the state that you can invest in. Same thing happening with Idaho. Boise, Nampa, Caldwell, Idaho Falls, Twin Falls, Coeur d'Alene. These are all incredible markets to look at. Houston, very strong market. The challenge with Houston is property taxes. So it works in certain scenarios, but not in every scenario, and not a highly recommended market. San Antonio, in my mind, is a little bit better. So San Antonio is a little bit of the, kind of the slow poke where Dallas has been running ahead and Houston's a much larger metro and Austin's a superstar. But I think San Antonio actually has a lot of room. Don't forget that that the secondary city often makes more money. There might be more money in Fort Worth than Dallas. San Antonio is only 60 or 70 miles away from the juggernaut that is Austin. And so I think that that's a terrific city. If you want a smaller city, if you're like, nah, not San Antonio, how about the city of New Braunfels? Look at this city. It's called New Braunfels. It's a German town that is in between San Antonio and Austin. You can live in New Braunfels and commute all the way to Austin, especially to South Austin, where the Tesla plants are coming in. A lot of the growth is in South Austin, where the airport is. So you can live in New Braunfels, and it's more eclectic. It's actually a more fun place to live in than San Antonio, which is another 30 or 40 miles south. Look at New Braunfels. I think that town is absolutely mind-blowing. Check that out. Now, if you find that New Braunfels is too expensive for you, I want you to take a look at another city. North of Austin, so New Braunfels is south of Austin. North of Austin, 67 miles away, is a tiny little town which people have not liked in the past called Killeen. Well, I can tell you this. Austin is the most unique real estate effect in America. It will raise every ship. Don't look at Killeen's past. Look at Killeen's future. There's room there for individual investors to invest. Am I investing in Killeen? No, it's too small a market for me. I'm investing in Austin, right? I can afford to do that. I'm investing in San Antonio and New Braunfels. Maybe you can't. Maybe it's too expensive. Take a look at Killeen. Let's see what else in this list. Orlando is a very strong market. I fundamentally believe that Florida is going to have climate change issues. Jacksonville and Orlando are the safest markets. Miami is the worst market for a 5-year or 10-year hold. I strongly advise against a 10-year hold in Miami. It's really the worst market in America for a 10-year hold because of climate change. If you don't believe in climate change, fine, go ahead and invest in Miami. Let's see what else is in here. Fresno is actually a very interesting market. For those of you that are Californians, take a look at Fresno. Madera is 20 miles from Fresno. Those are two very interesting markets to look at. Let's see, somebody asked me about Southern California. I'm not fond of Orange County, but I like Riverside. Riverside didn't show up in this particular list well because of the way that this list is structured. Sometimes you don't see cities, but Riverside is doing really well. Now, I have a dark horse, which is an early pick for me. This is a city I think I'm going to be talking about in the future, right? Very little has come from me, that those that follow me, very rarely have they heard of it. And that city is Omaha, Nebraska. Omaha, Nebraska, I think is a future dark horse. 2 years or 3 years from now, when I write the real estate trends, presentation, it might be listed as the dark horse. It's early, it's coming up. If you live near Nebraska, you might want to take a look at Omaha. Let's see, anything else in this list that is interesting to me? Cape Coral shows up here just a little bit under 2%, so I don't like that. It's a small market. It should be a little bit above that. But if you're in that area, Cape Coral, Fort Myers are two cities that are together on the the western seaboard of Florida. They're good markets to look at. And then here's one, Huntsville, that is at 1.93. Now, I want to point out to you that this data is 12 months old. Huntsville is currently one of the fastest growing markets in terms of job growth. If you are looking at Alabama, you're looking at Birmingham, you're looking at Dothan, I would pick Huntsville over all of those markets. I think it's a very, very strong and very unique, very interesting market. Take a look at Huntsville for future growth. So those are some of the markets. I don't want to go much down the list. If you want a few more nuggets, I'll give you one more. Logan, Utah. For those that like Utah, is an incredible market to look at. Logan, Utah, small market, kind of like where I'd say Logan today is where St. George was 5 years ago. So you got some room to grow there. St. George, of course, is still growing absolutely ballistic, but I think Logan's early in that process. So you may have missed the boat on St. George. I don't want you to miss the boat on Logan, Utah. All right. That's what I have from this particular area. I know you guys have questions. I'm going to take those questions now. Let's see what we have in the chat box in the Q&A section. I've answered so many of these. Okay, so Sheila says, what about Tulsa, Oklahoma? So I think Oklahoma City is a better option because Oklahoma City has significant population growth. Tulsa's population grows very, very slowly. Like, I really want to like Tulsa, Sheila, but its population has got to grow, and it's just not growing. Oklahoma City has a significant growth in population. So as long as there isn't an oil bust happening, you may want to look at Oklahoma City instead. San Antonio, so we talked about that. Does this apply to multifamily or single family? It applies to anything up to 4 units. If you're looking at above 4 units, you have to look at supply, and that changes. What do you think of Vancouver, Washington? That's a very expensive market, Tim. I don't think that there's any cash flow. Eric says, Idaho Falls, please. And have you picked your investment strategy? Are you doing apartments or fourplexes? Currently, I'm more focused on the fourplex market because it's extremely liquid, but I like apartments too. I mean, in Phoenix, we're doing apartments because that's what makes sense. So the answer isn't should we do apartments or fourplexes? The answer is, does it make sense for a certain market? Let's see. Can we say that the crime location of location magic is the least important of the 5 metrics? No, it's not. Absolutely not, Miguel. It's as important as population. It's just not as important as job growth. Let's see. What causes low cash flow? Miguel, high prices cause low cash flow. Wondering if eviction rules in a given city state should also be part of the criteria. Yes. at least 90% of the cities that I recommend, at least 90% are landlord friendly. So there's a few exceptions that we've talked about a little bit. Like Denver, for example, is not very landlord friendly at all, but smaller cities like Colorado Springs are. So stick with the smaller cities if you're afraid of, landlords and issues like that. The big cities tend not to do well. Notice that I never recommend New York, Los Angeles, San Francisco, Bay Area, Seattle. I don't recommend these, San Diego. These are good cities, but they've got very severe issues when it comes to being tenant friendly. Not my recommendations. Lots of people make money there. I'm not going to direct you towards those. Please give the coupon code for the bootcamp. Reach out to us. Oh, by the way, here, polling. Please take this poll. For those that are interested in our products, please take this poll. It really, really helps us in terms of what we should invite you to. As you know, we do a crap load of webinars. We don't want to invite you to all of them and so we learn about what you're interested in through these polls. So please answer them. It really helps improve your experience with our future webinars. All right. If you're investing in for the long term, 5 to 10 years, why is only 12-month job growth important? The answer is that job growth is not going to pivot easily. And Suri, even if you're investing for the 5 years, if you get 3 years of good job growth, you've had so much rent appreciation in those 3 years that you're set for the remaining 7. So as long as you use the system that I showed you properly and you pick the right cities, if you get 2 to 3 years of strong job growth, you are set for your 10-year investment. Just 2 or 3 years. Like in St. George, we've raised rents 30% above pro forma. That was our 5th year of rent, and we're there in the 1st year because St. George's job growth is just so ridiculously astonishing. Let's see. Is there a minimum number of jobs that you need to qualify? Yes, very important. Mac, excellent question. Yes, on that page, on the first row, if the market has less than 800 jobs that are added, I tend to skip the market because that's too low of a number. So 800 is a good number to look at in the first column on that job growth page. So 800 jobs minimum. Will you be updating neighborhood level real focus metrics? No, we've expanded them. They are now in the bootcamp alley. We will not be updating them. Let's see. What about Irving, Texas? Well, Irving is Dallas. Anything I said to Dallas applies to Irving. Any cities in Oregon? Oh, yes, we missed out on Oregon. Bend is very interesting. Portland, not so much. I think Portland's now a superstar city. There's really no yield left. Bend's very interesting, even though it's fairly expensive. Eugene, I think Bend and Eugene are more interesting. They're not cheap. Oregon's not cheap. Oregon's also landlord, tenant friendly, not landlord friendly. But I think Oregon is special. And if you want to know why Oregon is special, look at my climate change webinar. Look at that climate change webinar. I think a 10-year hold in Bend or in Eugene is going to do really well. You're going to have short-term, cash flow issues. Let's see. How do you figure out which market is better for apartments versus SFR? That information takes an hour to cover. It's in our bootcamp. I cannot provide it in a short format. Santa Fe, New Mexico. That's interesting. That's interesting. So I'd say Santa Fe is better than Albuquerque. Sometimes secondary markets do well. So Kerp, I'd say Santa Fe is definitely a market to look at. Would I pick it in my top 10 list? No. But if you live in New Mexico, you live nearby, not a bad market. Let's see, Brownsville, Texas, too small, so I'm not going to comment on it. Modesto is very interesting, actually. I like investing in cities that have come out of bankruptcy because the city officials tend to have their heads screwed on right. So I'd say Modesto is a very interesting city. Let's see. Why did you skip Ocean City, New Jersey? There's some fundamental issues with Ocean City, New Jersey because of the casinos. And in my mind, the city tends to fluctuate up and down very radically, like Odessa, in terms of the oil cities. And so when I see a city fluctuating up and down, I don't recommend it. Any thoughts on Newark, New Jersey? I think Newark is a very strong market. It's benefited a lot from the pandemic. In general, I'm not bullish on New Jersey for the next 10 years. That's the only reason why I don't talk about Newark. Wenatchee, Washington, I think it's an interesting market. You should look at it. It's pretty small. Let's see. Cash flow in Fresno, California. Fresno is in California, so the cash flow is low, but I think that there's quite a bit of appreciation there. Let's see. Sacramento. I think Sacramento is a good market for those people that want to invest in California, right? So there's people who are like, I'm going to invest in California, California, and California. Okay. In that case, Riverside, Modesto, Madera, Fresno, Sacramento are good options. Take a look at those, right? Am I investing in California? No, I love California. I live here. I'm going to live here until I die. I'm not investing here. Let's see. Boom, boom, boom. So Ziad says you mentioned Indianapolis as a dark horse, but according to IRR, Indianapolis is in hypersupply. So IRR viewpoint is one document that I do not like, Ziad, because it takes you in the wrong direction. They understand, they don't explain it well that cities go into hypersupply and out of hypersupply. They don't explain that it goes both ways. So that is a document that is very misleading. I understand what they're trying to do. It is not a good document to use for your investment reasons. Also, rents there have not risen correct. Notice that Indianapolis doesn't do so well on the real focus system because it's accelerating. Dark horse is a status for a market that may not seem well looking at the past, but may have some unusual circumstances of growth. So if you look at the past, Indy doesn't do well. That's why I would never pick it as my number one city to invest in. That's Phoenix. But I think it's this kind of city that is taking off now, and my data is showing it on that upward momentum. So don't look at the past for Indy. It doesn't look good. I still think that if you look at current data, it looks really, really strong. Let's see. Nevada, Sparks, Reno. I'd say Reno more than anything else. Las Vegas is also a good market to invest in. I know people are afraid of Las Vegas. I still think it's a phenomenal market. I still think that everyone should be looking at Vegas. I think both Reno and Nevada and Vegas are very strong markets. Sparks, maybe not so much. Medford, Oregon. Yes, I like it. I like Medford as much as I like Eugene, as much as I like Bend. So all three of those are good markets. Let's see. Fayetteville, North Carolina. A little small market, interesting market. I like Fayetteville. So yes, it's a very strong market, Karen. So be careful, but it's definitely an interesting one. How do you get a boot camp for the coupon for the boot camp? Ask us. We'll send you one. So you can email me, by the way, Neal, Neal, Neal at growcapitalist.com or Neal Bawa at gmail.com. Either one of those work. Any good markets in Pennsylvania? I'm not very bullish on Pennsylvania because of Pennsylvania's failure to increase its population over a 2-year, 5-year, 10-year time frame. So my suggestion is you live in Pennsylvania, Philadelphia is as good as any place. I'm not bullish. I think there's better places. Let's see. What about cities close to the Bay Area? Stockton, Concord. Concord is in the Bay Area. Very expensive. Stay away. Stockton, yeah, Stockton's interesting. New Haven, Connecticut. I'm going to skip that. I like to joke about Connecticut emptying out a lot. New Haven is exempt from that. It's not emptying out, but its state is emptying out. Stephen, don't invest in states, even in good cities. They're going to get dragged down by what's happening in the state. Let's see, San Diego. Yeah, San Diego's great, but super expensive. How do you get any cash flow? Any other markets in Florida? Sure, I have lots of markets, Peggy, in Florida. Sarasota, Sebring, the Villages, Ocala. Florida is filled with these small markets that are really great, Peggy. Let's see. Huntsville, Alabama versus Research Triangle Park in North Carolina. What would be your pick today? Oh, that's really, really easy. So Huntsville's a great market, but the Research Triangle area is phenomenal. North Carolina beats the crap out of just about everything in the US, including Huntsville. Will real estate bubble pop happen in Phoenix since it has 70% investment ownership? This is a question I get a lot because Phoenix has a track record of blowing up. I've gone to multiple webinars from people much smarter than me who have taken a lot of pains to tell me, Maha, that this time it's different for Phoenix. It's going to take me an hour to explain, but this time it is different in Phoenix. Just look at the job diversification in Phoenix. I'll just give you that as a 5-second answer. How's the cash flow in Medford, Oregon? Pretty bad. I still think it's a great market. What will happen when all COVID-related funds dry out from the market? Nothing. I mean, the market is supported. The market only needed to be supported over the last 12 months. Now fundamentals will take over, Prashant. I think we'll do fine. What are your final top 3 cities? That's a really hard one. I think there's no such thing. I gave you cities dependent upon what you want to do. If I had to pick 3, it would be Idaho Falls in Idaho, St. George in Utah. Let me pick a third. New Braunfels in Texas. Those are my 3. Let's see. Boom, boom, boom. How do we get the spreadsheet? Oh, yeah, the Excel spreadsheet and the PowerPoint deck, everybody will get it emailed tomorrow, along with your recording. Tyler, yes, I think Tyler's a strong market. Victor says, Tyler, Texas. Yes, I think that's a better market than Dallas. Virginia, low cash flow. That's why I don't talk about it. Fort Lauderdale, very expensive. That's why I don't talk about it. Chicago or Milwaukee, I don't recommend it. Chicago is a $500 billion economy that is likely to melt down over the next 5 years because they are out of money. When it does, it is going to hit Milwaukee and Indiana very, very hard. So how many markets are you looking at any one time? Well, we do, weekly market analysis meetings. There's about 200 markets in there. Can I get a replay? Yes, you'll get it tomorrow. Let's see. Is there a metric or an analysis process we can use to determine when rising prices will have a negative effect on cash flow? Miguel, that happens 100% of the time. Rising prices affect cash flow. Let's see. If you think cash flow in Medford is not good, why do you think Medford's a good city to invest? Medford's a good city to invest in for 10-year investments. There's a lot of good stuff happening in Oregon, Bend, Eugene, Medford, Portland. There's a lot of good stuff happening there. So for patient investors, Medford is interesting. If you're not patient, there's lots of better places. Let's see. What about Palm Springs? Very expensive. Cash flow issues. Would you avoid coastal cities in Florida due to insurance costs rising? Yes, absolutely. I would avoid coastal cities in Florida because of insurance rising. Having said that, some of the best cities to invest in America are the coastal cities. So if you're worried about that, what you need to do is to kind of move in a mile or two, move a couple miles inland. That way you can enjoy the benefits of those cities, but not have to deal with the insurance costs being high. So go one city over on the inland side. It's also a bit cheaper. And yes, you're right, Ian. Florida, 5-year exits are better. 10 years, not so good. What city is your #1 cash flow market? That's a tough one. I'd say Jacksonville. Atlanta, Lithonia. Lithonia has high crime, so I would recommend against it, but Atlanta is a terrific market. Suburbs of Atlanta have the highest forecasted 5-year cash flow or rent increase in the United States, 25% over 5 years. That's forecasted. It might be higher than that because the forecasts tend to be they tend to be very cautious. So I think suburbs of Atlanta are interesting. Atlanta itself, now expensive, not expensive compared to the rest of the US, but, fairly expensive. So what I'd say is look at places like Fayetteville, in Georgia, which, we own a property there. It's doing really well. It's about 35 miles south of Atlanta. So take a look at those. Another market that is very north of Atlanta that is a favorite of mine is Dalton, Georgia. So take a look at Dalton, Dalton. So that's a very, very interesting market. Is Jacksonville, Florida market that climate change would directly affect? Jacksonville is the least affected market in climate because the Gulf Stream ends there. So there's warm waters off the Jacksonville coast, which tends to slow the hurricanes down. So it could get hit by a hurricane, but it's less likely to. So people who are Floridians look at Jacksonville as a better market from a climate change perspective than, let's say, Miami, which is the worst market in America for climate change. Let's see. Any take on Ann Arbor, Michigan? I think it's a great market. It's also expensive, but a really nice market. I'd love to own something in Ann Arbor. How do you take school ratings into account? The short answer is if you look at the ratings I gave you today, you don't have to take school ratings into account. Because if I added a sixth parameter called school ratings, I'd end up with the same cities, right? Also, school ratings don't mean anything at a city level. They only matter at a neighborhood level. Come to the boot camp. We'll teach you more about that. Why is Miami not a good market besides that it's expensive? Well, firstly, it's crazy expensive. Second is that institutional investors have made the decision that climate change is real. It doesn't matter if it's real or not. They've already made that decision. The number one city that they use as examples of a place that they will not invest in the future is Miami. Number one in the US. All right, that's our last question. I usually stop at the 70-minute point. I'm glad you guys enjoyed this event. There's still 200 of you. Thank you all for coming. I have a fantastic event coming up in 3 weeks, so I want to plug it. Top 10 disruptive trends that will change real estate forever. So come to that one. I'm pretty sure there's going to be 500 of you watching that one. It's got everything from tokenization to artificial reality and all kinds of other stuff that is changing real estate forever. I'm so excited about that presentation. I will see you there in 3 weeks. Thank you so much. Bye-bye.